Hi, I'm Jenny Brown. Welcome to MFB News. I hope you're all doing well and had a really good week. All good here. Had some movement on the house purchase side of things. We now have a buyer, so hopefully we are all systems go. Again, we're on our sixth incarnation of buyer now. So if this happens, it'll be a miracle, but we continue to hope. And hopefully we'll be in for Christmas, that infamous saying, but let's see. I've got some interesting stuff to cover off with you today. We're going to talk a bit about swap rates actually and what's going on with them and what this means for you as borrowers. We're also going to run through some other changes we've seen in the market in regards to pricing and criteria, and then we're just going to take a quick look at the Halifax House Price Index and let you know what's going on there and what that also means for you. So some good stuff to cover off today. Okay, so this week, to start us off, I just want to talk a bit more about swap rates and what's going on with them and what this means for you as mortgage borrowers. So first of all, what is a swap rate? So essentially a swap rate is the rate of interest that lenders will pay when they borrow money via the wholesale markets and re-lend it to you as mortgage borrowers. So there are really two types of lender. There are those lenders who lend off of balance sheet, and what this means is essentially they have money in their own rights, which they're going to re-lend out to you. So think people that you would save money with. So clearing banks essentially. So Santander, NatWest, these guys, you give them money, you save money with them, and they then re-lend it out and charge interest on that, which brings them a margin of profit, which they then use to then pay you and also, cover all their costs and make a profit themselves. But there are other lenders who don't have the same kind of balance sheet in the background. So these guys are borrowing money from the wholesale markets and re-lending it out. And this tends to be more of the specialist lenders. So for those of you who are watching this, who are using limited company structures, investing in HMOs, multi-units, that kind of thing, people with very large portfolios, this really is very, very relevant to you. But likewise, this can impact everybody, so even the clearing banks, because ultimately swap rates are a rate of interest that institutions are charging each other for lending money. And if they go up, what that ultimately means is that you will find that the cost of mortgage borrowing will go up too. So in front of you, you're going to see now a graph, which on first sight, I'm sure just looks like a really boring graph. But what's really interesting here is if you look at it, this period of time that the graph is covering is from this time 2 years ago. And we will see that on the far left-hand side, rates were quite high. And then as we went down through 2020, they came down really, really low, and they sat at a very low position until really sort of January of this year. And then what they've started doing is going up again. And what you will see on the very far right hand side is a very, very sharp curve where things have started to climb very, very rapidly. I mean, we're almost vertical on this curve at this point in time. So what this is showing what swap rates are doing, and you will sit, or you may or may not know, but there are different types of swap rates. So there are 1 year, 2 year, 3 year, 5 year, 7 year and 10 year swap rates. And this graph is showing you the cost of 2 year swaps, which is the bottom line, and 5 year swaps, which is the top line that you will see there. But fundamentally what is going on is they're both largely reflecting each other. The rate of interest rates on swaps is increasing, and it's now actually significantly higher than it has been for 2 years. So what does this actually mean? It means the cost of money on the money markets is going up. So when a lender such as, one savings bank wants to lend money out, and there's lots of lenders we can use here, Hampshire Trust, Keystone Property Finance, and all the specialist lenders, the rates for these guys is increasing. And what that means is that if they continue to lend to you at the very, very low pricing that they're currently charging, they're going to be making a loss. So what they're going to have to do is put their pricing up to cover their costs, because the cost to them of bringing the money in the first place has also increased. So the message here is very much this: the price of mortgage interest rates is going to go up. I know that base rate hasn't moved. I mean, that's a whole different conversation about when that will go up, but the cost of money, of fixed rate money, is increasing. The cost of borrowing at the moment is incredibly low. So really the message is this: the time is now if you are in the market for a mortgage, or will be in the near future. So look, if you're looking to buy a property at the moment, you cannot put a mortgage application in and secure a rate unless you have found a property to buy. So if you're thinking about buying in the coming few weeks and months, actually you probably would be best advised to really think about expediting your plans and bringing them forwards if getting a very good interest rate is important to you. If unfortunately you do not buy a property and interest rates have gone up, then unfortunately you're just going to have to pay what is being charged at the time. But you cannot secure a rate unless you have a property in mind, because we cannot submit a full mortgage application without there being a property. So the only way you can secure a rate is to submit an application. Once the application is in, your rate is secured. Okay, that's a really important point to note. Now, people who are remortgaging, this is slightly more interesting. So look, when we do a remortgage, we need to allow circa 4 weeks, it can be quicker, but say 4 weeks to get your mortgage offer. Your mortgage offer will then be valid for between 3 and 6 months. So what this means is if we work on a timeline going forwards, I could make a mortgage application today. My mortgage offer would come through in the middle of November. I then have a further 6 months on which to draw that money, which takes me to May in 2022. So what that means is that if your rate is not ending in the next couple of months, but actually is ending before May 2022, there's nothing to stop you applying for a mortgage now and securing a rate at today's money, knowing that come May of next year, probably rates will have gone up. So this is a really, really good bit of advice for those people in the market there. So look, that's the kind of key situation in terms of where things are. I think it was really important to show you this because swaps have really started escalating in the last couple of weeks. The reason for this is largely due to expectation around interest rates going up in the longer term. If anybody wants me to really go into this with them, the ins and outs of how this actually works, by all means get in touch. I'm very happy to do so, but I don't think you need that level of detail for this. The graph really speaks for itself. You know, the data is there. It's not our data. This is from the money markets. It really shows you what you're doing. So consider yourself told that if you are looking for a mortgage rate, remembering the pricing is now starting from an incredible 0.99%, now really is the time to act. Moving on to lender updates now. So first of all, we've had some movement from LendInvest, who have made some very good improvements to their offering for you. So first of all, they've dropped the pricing down on their holiday let products. Their pricing here now starts from 3.59%. Now LendInvest are a lender who is not going to use the actual holiday let income. They're going to use the default AST income instead. But the rates are very, very good. They're able to do this for limited companies and also individuals. They've also brought their pricing down across their range on their standard buy-to-let products. Pricing here is now from 2.65%. This is available to individuals and limited companies. I'll come on to a bit more about their criteria in a moment. Now they've also reduced their rates on their kind of green range, as it were, so for properties with a rating of A to C. And they've also introduced some new 7-year fixed rate products, which have pricing starting from 2.88%. Now, in terms of LendInvest as a lender and what they're like, so look, we really enjoy dealing with them. They are a relatively new lender. I'm saying that they've probably been around for like 4 years or something, but in the scheme of things, they're quite new. And they've got some really nice pieces of lending policy built into their offering. So you can be up to the age of 80 when you apply for a mortgage with them. The mortgage has to be paid off by your 85th birthday. They can accept applications from individuals or limited companies. The companies do need to be an SPV, but they can be layered companies, so company owned by people. They have a no minimum income requirement policy. They don't mind how many properties you have in the background. You can have no more than 20 properties with LendInvest. They are also good for first-time landlords. They don't mind shorter leasehold properties. There must be at least 70 years at the point of application. It's not the most racy, but you know, it's still better than some. And they are able to accept 25% site exposure. So what that means is if you have a development of flats and there are, say, 20 flats in the block, they would be able to lend on 5 of these, whether it's 5 to you or 5 across, you know, all of their lending to other people as well. But that's kind of where they sit there, which is quite good. And lastly, they're able to consider 70% loan to value on new builds. That's new build houses and new build flats. Now, I was answering a question for some industry press that I write for in the last few days, where someone was saying, asking what the policy is from lenders on new builds. Now, lenders do sit in varying positions on this. So some lenders are happy to lend on new builds at their maximum loan to value, whether it's flats or houses. Other lenders will restrict the loan to value depending on, you know, well, some lenders are fine with houses but not flats. As you will see with LendInvest here, they're actually capping at 70% on houses and flats. And there are some lenders actually who don't like new builds. I mean, that's very few and far between that they do exist. But I think the key message here that the new build lending did go through a relatively bad time when we had the credit crisis, but that does seem to have resolved itself now. So look, a really good offering from LendInvest with some great pricing reductions. The lovely people at BM Solutions have made some pricing reductions, bringing their rates down to a very competitive price point. Rates are now starting from 1.05%. I mean, look, come on guys, if you need a mortgage, why would you not want to take pricing at that level? So look, BM Solutions as a lender, you know, they are, I hold them very close to my heart actually. They've been around for a really long time. You know, in times gone by, they were one of the largest buy-to-let lenders in the UK. Not so much these days. Things have really moved on. So, for example, BM Solutions are not offering mortgages to limited companies. So they've kind of stuck doing what they know, but they do what they do really, really well. So here are some things about BM Solutions for you. So like I say, personal borrowing only, no minimum income requirement. You can have a maximum of 5 buy-to-let mortgages with Lloyds Banking Groups. That incorporates brands such as Cheltenham and Gloucester and Lloyds. As well, and also the Halifax. If you've ever been able to get a buy-to-let with them, they did dip into that space for a short period of time and then duck back out again relatively quickly. Now their products do have incentives as well, so on remortgages there are products there with free valuation and cashback for legals. They also have flat arrangement fees, so none of the products with BM Solutions have percentage charge fees. They are all flat, which can work out very, very well for some borrowers, and the pricing is really good. Now the other thing with BM Solutions that I would say is that their system, they've invested a huge amount of money into their IT systems, which is great to see, you know, a long-standing lender doing such a thing. And so actually what they're able to do is operate in an incredibly fast fashion. We find that if we have a landlord with a smaller portfolio, it's less than 4, they are producing offers in record time. They're also able to lean quite heavily on the ability to use desktop valuations as well, which can really help expedite things. We're certainly finding at the moment that valuations are taking a fairly long time to book in. Why that is, I don't know. Maybe the valuers just need a holiday after the stamp duty rush. They've all worked so hard. But actually, you know, like I said, there is a long run in time, so that can be really useful for people who need to operate at double quick time. The other thing about BM Solutions that I really like is their offering to existing borrowers. So if you are a borrower of BM Solutions, very often we will find that we won't end up remortgaging our clients away from BM Solutions when their rate ends, because the offering they have to existing borrowers is very, very good. Now, why is that important? So look, you know, ultimately when your fixed rate ends, the decision to stay with your lender or move on is largely driven by numbers, you know, which is going to be financially most advantageous for you. But actually, if you do stay with your existing lender, the sense of applying for that sort of switch in product is so different from applying for a new full mortgage. Because largely what we can do is simply just click a few buttons on the lender's system and they just facilitate the product switch. So there's no full application, there's no underwriting. So this can be really, really good for some borrowers, either people who are short of time, whose situations have changed, and maybe aren't hitting the mark with lenders at the point in time when they need to switch products, and also those people who simply just want a quieter life. And you know, let's face it, we're all pretty time poor these days. So actually that can be really good as well. So for that reason, I also really, really rate BM Solutions as a lender. So good to see them bringing their pricing down, and look, from 1.05%, you know, you really can't knock it. Lastly for you guys this week, a quick update on house prices. The Halifax released their house price index, which revealed that UK house prices rose by 1.7% in September, which equates to an increase of £4,400 to the value of the average property. This translates to the average UK property now being recorded as being worth a record high of £267,500. Now, I was reading an article where a chap called Mark von Grundher, who's the director of Benham and Reeves, has provided some commentary around what he thinks is happening. I think actually for you guys this is the really key bit. So what he said is that actually the stamp duty holiday clock has now well and truly expired, and those who have seen a last gasp saving would have entered the market many months ago in order to complete on time. So what he's basically saying here is that actually the fact that house prices are still performing so strongly is not down to the stamp duty holiday any longer. We can't lean on that as a kind of excuse. Actually, fundamentally, the housing market is now really standing on its own. And the fact that house price growth is continuing really just kind of is symptomatic of how the market is performing under its own steam. Now, interestingly, what he's also commented on is London. Now, as we all know, London has probably had the hardest time, both in terms of house price values and also rental demand and rental yield. But what he's saying is actually the London market is really gaining momentum, and it's looked set to snowball during the autumn and winter months. So as a result, our money's on London to finish the year with the most impressive performance where house price growth is concerned. So there you go. So look guys, I know I keep banging on about this, I'm sure it's incredibly tedious for you, but the reality is that house prices are not going to go down. The reality is that house prices are going to go up and interest rates are going to go up. So if you can find something to buy, and actually I believe for a lot of investors that's the bigger challenge, is actually just finding something to buy at the moment. But if you are successful, the time really is now for you. And that is us for this week. Thank you as always for joining me. Really appreciate you taking the time to have a watch of our video and see what we have to say. Also, just some news for you. I'm going to be speaking at the Property Investor Show at the EXO in London this Friday and Saturday. Our Mortgages business will have a stand manned by some of our wonderful consultants. So if you are there, please come and find us. We'd love to have a chat with you. The show is free to attend. There's over 100 exhibitors. It's actually a really good show, to be honest with you. There's lots of stuff with regards to UK investment, UK mortgages, various things that are really kind of handy for property investors in terms of fitting properties out, insurance, tax advisors. There's also some stuff on overseas investment as well, which if it's your bag can be really, really useful. So look, if you've got some time either Friday or Saturday, do come down to the Excel. We'd absolutely love to see you. And if you're really stuck for something to do, you can even come and watch me speak. So look, we'll catch you next week. As always, if you have any questions, give us a call 0345 345 6788. And as always, there is lots of information on our website. Please do go and have a nosy round on there if you've got some time, see if there's anything useful for you. And I will catch you again next week. Look after yourselves until then.